The week's biggest headline grabber may be the G20 meeting, which starts in Buenos Aires, Argentina on Friday the 30th of November. The big question will be whether America's President Donald Trump and his Chinese opposite number Xi Jinping can strike a compromise that avoids further tariffs and lessens the risk of a trade war between Washington and Beijing. Now, admittedly, the signs aren't great. This month's Asia-Pacific Economic Cooperation Summit, or APEC, in Papua New Guinea ended without a joint statement for the first time ever, according to the Financial Times newspaper, as talks between America and China made no progress at all. Any sign of an agreement and a lowering of tensions could be seen as a good thing for share prices around the world, since markets remain wary of the risk of higher tariffs in a trade war, both are seen as potential negatives. A trade war could be bad for global growth, and tariffs could drive up inflation and thus interest rates. Remember that if there is no agreement, America will increase tariffs on $250 billion of imported Chinese goods from 10 to 25% on January the 1st, and will also look at slapping taxes on another $267 billion worth of Chinese product. Now, company-wise, there's just a couple of FTSE 100 firms scheduled to release a statement in the coming week. One is inspection and testing expert Intertek. It's slated to release a trading update on Tuesday the 27th of November. Now, that should be interesting in itself, as the firm is a play on global trade flows, at least in part. The other one is Ferguson, the plumbing equipment distribution expert formerly known as Woolsey. It's due to host its annual general meeting on Thursday the 29th. Watch out here for any comment on current trading, not least as the firm gets around 90% of its sales from America. Besides those two, a number of FTSE 250 firms and small cap stocks are expected to be updating the market. They include pork products company Cranswick, utility Pennon and retailer Tops Tiles on Tuesday the 27th of November, plastic packaging expert and takeover target RPC on the 28th, pubs group Green King, travel agent Thomas Cook, transport company Go Ahead and fizzy drinks maker Britvic on Thursday the 29th. However, the company most capable of causing a fuss in the week ahead is probably Shaftesbury, when the Real Estate Investment Trust, or REIT, releases full year results on Tuesday the 27th of November. The shares have not had a great year, as we can see here, gently sliding for most of 2018. This is very much in keeping with the real estate investment trust sector overall, in fact not just in the UK, but globally. This, by the way, shows the UK FTSE all-share sector for real estate investment trusts. Now, key concerns have included what Brexit may or may not mean for the UK economy more generally, and that of London more specifically, since Shaftesbury's portfolio of property is focused on London's West End. Additional complications have been tough trading for restaurant groups, where there have been some high-profile casualties, and worries over how the internet apparently continues to hollow out the high street and the operating model of bricks and mortar retailers. Shaftesbury's assets cover nearly 15 acres of prime central London, including buildings in Chinatown, Covent Garden, Fitzrovia, Carnaby Street and Soho, some 600 buildings in all. As we can see here, restaurants and cafes represent 36% of current annualised income, shops 32%, offices 18%, with the residential sites covering the remaining 14%. When it comes to the full year figures, analysts will initially look at three things. The first is the headline net asset value, or NAV per share figure. At the first half stage, this was 983p, and as the shares trade around 900p as I sit here, that's a discount of some 8%. We can see the trend in NAV per share right here. We can then see in this graphic where that puts Shaftesbury relative to its real estate peers. The discount's a lot smaller than that at, say, Land Securities or British Land or Hammerson. Shaftesbury has no exposure to financial services. Its assets are all in London's prime West End, not the city, for example. The second thing that analysts will be looking at is the vacancy rate. Now, that was 5.6% at the first half stage, although that did include 2.5% of its assets that were already under offer. We can see the post-financial crisis trend here, and analysts will be looking also for updates on rent renewals and existing properties, as well as developments at three recently acquired sites. They're Broadwick Street, Neal Street and Great Marlborough Street, which were 62% let already at the first half stage. And then the third issue, well, that's the balance sheet. Shaftesbury raised £260 million last December to fund acquisitions in development schemes, and net debt was £779 million at the half-year stage, enough for a relatively lowly loan-to-value ratio of 22%. Watch out for any commentary on Brexit and the West End economy, as well as on retail and restaurants more specifically. Note also how residential is already 14% of Shaftesbury's portfolio, up from 7% a decade ago, and greater mixed-use development, including housing, was a theme of the recent interims from both Land Securities and British Land. So let's see what Shaftesbury has to say on this trend. Thank you for watching, and I look forward to seeing you next time.